We're looking at one of the biggest stories in healthcare, a category killer during the next 5 to 10 years.
What do your analysts think Teladoc is worth per share?
Teladoc is thinking big. You ask us, what is our price target out there? Well, a 10-fold increase. This is like Amazon. We see Teladoc in the same league as an Amazon.
TDOC is down 96% from its all-time high. They are reporting earnings next week, and in this video, I am going to do an in-depth analysis of the company by looking at the financials, the balance sheet, and using my Google Sheet to calculate the intrinsic value of the business. Starting with their financials, their revenue grew a lot during COVID, as they provide virtual healthcare services. However, their revenue growth has slowed down since then. Last quarter, they only grew 3%, and analysts are expecting them to grow between 3 and 6% for the next 5 years. Keep in mind that they grew 97 and 85% during COVID years. Regarding profit, they are expected to become net income positive in 4 years. However, they have been free cash flow positive for 3 years, and they currently have $199 million of free cash flow. They also have 90 million members, and their international segment is growing at a faster pace than the US segment. They also announced a new CEO last month with the hopes of turning things around. Then, in order to calculate the intrinsic value of the company, I use my Google Sheet, which tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. Right now you're seeing 6 numbers. The top 3 are based on net income and the bottom 3 on free cash flow. They mean 2 things. First, in order to make the desired annual return that I have put in, which is 15%, you need to pay these prices. Second, that if the low assumptions occur, you're going to make a 22% annual return on your money, middle 44%, and high 62%, which are insane returns. I think my middle assumptions are reasonable, as I have the company growing at 5% annually, which is what analysts are expecting, with 16% profit margin and free cash flow margin. This is the hard part about valuing the company, but I think they can achieve this because of their high gross margin, which is around 70%. For example, Microsoft has a gross margin of 70% and a profit margin of 35%. Moreover, TDOC is already showing a free cash flow margin of 7%. I also assigned a 19 p.m. price to free cash flow to the company and left the share outstanding change at 0%. However, they have been issuing some shares, and if we assume they continue to issue 2% of their shares annually for the next 7 years, their valuation becomes less attractive. Moreover, they are selling for a price to free cash flow of 7.9 and a price to sales of 0.6. For comparison, Palantir is trading for a price to free cash flow of 93 and a price to sales of 25. In conclusion, TDOC is trading very cheap. Regarding the balance sheet, they have $1.1 billion in cash and cash equivalents and $1.5 billion in debt, and therefore it's a good balance sheet. In conclusion, if you believe in the products of this company, I believe this is actually a very good investment, which might surprise some of you. They are struggling to grow, but their profitability is improving massively. The valuation is very attractive and their margins are very good. Moreover, this is a company that might get acquired. Remember that this is not financial advice and you should always do your own research. I hope you found this video valuable. Let me know what you think about TDOC in the comments, and I'll see you in the next one.